And you're just in time for your weekly most comprehensive look at the world of business, finance, and economics. Welcome to another edition of Business Redefined. We have had talks about pension before, but this conversation can never be exhausted because every time there are emerging issues, whether it's at the policy environment at the macro level or at the micro level. And tonight we are delighted to have George Nyakundi, the CEO ICEA Lion Life. Karibu sana.
Thank you, Julian Amboko. Thank you.
So, George, let's start from here. It's been a landmark year. We finally had the courts pronounce themselves on the matters of NPSF Act of 2013. If you could just give us your thoughts around how this has recasted the pensions landscape in Kenya.
Just before the act was enacted, I think the pension area in Kenya was confined to a few employers.
Yeah.
Mainstream employers take care of their employees by providing some form of pension contribution to support their retirement. We think the NPSF Act, as it is now, provides an opportunity for many other employers who are hitherto not involved in the savings aspect for retirement for their employees, now being brought into the pool to be able then to provide retirement benefits for most of those employees and employers who are not in the pool. The propensity to save in Kenya and in East Africa is low in terms of retirement benefits. Yeah. Not many people are able to save for the retirement when it comes. And so the NPSF Act, as it is now, provides an avenue for many other employers to set up some form of pension retirement scheme for their employees, to provide at least something small for their employees when they retire. It widens up the opportunity for employees also to provide an avenue for them to save towards their retirement, either by increasing their personal contributions, what we call the voluntary contributions to these pension schemes, together with employers and their personal contributions. That then sets a pool, a small pot for retirement when the time comes.
I see. And many times we have this conversation on pensions. The youth who are watching the show always ask me, how do I know the right amount to be contributing towards my pension? I'm really curious to get your thoughts on that.
Typically, I think when it comes to actuarial science, typically when we want to save for insurance, it's perhaps 10% of our income should go towards insurance. And the youth should be advised that sooner or later they'll be aging, they'll require funds to support them in old age. And they therefore need to set aside a portion of their income towards that particular goal. Typically, if they are able to save, say, 10, 15, 20% of their income, together with employers, if any, that will cushion them against any volatility when it comes to retirement. Indeed, the youth now need to be socialized to start saving now because of the compound interest component that then makes the funds to accumulate at a very fast rate to afford them a decent retirement package when they leave employment.
And another oft-cited question is pension schemes in this country have often been perceived to be the preserve of those in formal employment. How do we begin to rope in the informal sector into pension services?
As ICEA, I think we have for a long time tried to venture into the informal sector by providing special solutions, retirement solutions to the informal sector.
Yeah.
Our personal pension plan, for example, does provide an opportunity for those in the informal sector to save towards their retirement in their formal pension scheme, known as PRS, Personal Retirement Benefit Scheme, where they come together, either an individual as a group, and provide savings, regular savings, that then are invested to provide for their retirement. But I think that agenda needs to be discussed further. And I think with the onset of the NPSF Act, it does therefore invigorate the idea that savings for retirement is a normal thing. It is necessary because as we age, we need support. But also there are avenues, there are products that then provide for people, employees or business people in the informal sector to save towards that retirement goal.
And for many now, speaking about the NPSF Act, many still ask, we hear a lot about Tier 2 contributions. For those viewers who are still not clear what this is, please just explain to us and how ICEA plays in that space.
So the NPSF Act brought into aspects of the contributions for pensions. One, the creation of Tier 1, which means these are compulsory contributions to be remitted to NSSF. The traditional NSSF was a provident fund, meaning it only provided for a lump sum at retirement.
Yeah.
And as we know, our saving culture isn't very good. Equally, our spending culture isn't very good. So if you provide a lump sum to retirement people, to retiring employees, the experience we have is that that lump sum is usually spent over a very short time. So the introduction of the pension scheme as part of the NSSF is a good and welcome move, because then it allows for retirement members of staff or employees to have a pension scheme that pays a regular salary, like a pay slip, like a salary every month, and then guarantees them a formal income every month to support themselves at retirement. And then that's tier one. Tier two is an option for employers either to remit the additional contributions either to NSSF or to a registered pension scheme that is registered and recognized by RBA, which means tier one is compulsory, but tier two then is optional. But to be able to opt out, you have to get approval from RBA that you are duly registered as a retirement benefit scheme provider, then that adheres to the rules of RBA. Then only then can you be allowed to opt out and be part of tier two contributions to a private pension scheme.
Yes. One of the questions which is emerging right now, George, is that if you look at the investable environment out here, it's been quite eroded because of global macro factors, not just even Kenya specific. Whether you're looking at returns on equities, whether you're looking at the bond side. And the question being asked is, how are fund managers such as yourselves positioning yourselves when it comes to this environment, which is largely adverse?
I agree with you, Julian. The current economic environment has forced us to think about outside the box. Traditionally, I think insurance fund managers and insurance companies have invested in traditional assets, investment assets. We talk about government bonds, T-bills, equities, and as you've rightly said, as we see interest rates going up, the value of our bonds goes down. Yeah. Equities are down already. So I think the solution to that is to think outside the box in terms of alternative assets to invest in. As ICEA, we are thinking alternatives. We were thinking about going into REITs, real estate investment trusts. We are thinking about offshore investments. We are thinking about investments in alternative energy, renewable energy, alternatives in terms of private equity. All these, therefore, will come in to support our traditional model of investing in the traditional assets. So alternatives does appear to be the solution. But also, if we repurpose our investment assets, see how much then we put in government bonds, how much do we put in T-bills, to rebalance our portfolio to make sure that the risks that there are in various investment assets are then balanced to support the company in terms of provision for benefits to our members.
George, I received this question many times that if I'm in formal employment, I already have a scheme which runs. Is there any reason why I would again be having a personal pension scheme on the side? Your thoughts on that?
Usually, employer contributions are normally a percentage of our salaries. Sometimes employers are not very generous for various reasons, because of economic pressure on the payroll, etc. So the percentage of contribution provided usually by employers may not be that big. So if an employee has some additional income or a buffer, they can opt to contribute an additional out of their own income to support their retirement benefit. That is allowed. It's called AVC, which then allows for employees as members of schemes to contribute slightly more than what the employer is offering. Now that gives them an advantage, because as the lump sums grow, interest declared is then given on the entire pool, not on the specific employer contributions. That way, the retirement package, the retirement funds available for retirement for this particular member keeps on growing over the years, and is a handsome lump sum given at retirement once these contributions are put together and invested well. Of course, taking advantage of the tax concessions that come with that.
I see. For those who are in the Gen Z category and they're more digital savvy, how does ICEA then ensure that you reach that demographic?
Again, in terms of preparation for that, yes, we are prepared. We have developed digital assets to allow for the millennials, so to say, to save convenient-free, friction-free, in terms of building portals where they can come in, identify which product they want, enroll for it online, and start their contributions online. And everything is done seamlessly because of the technology that we've deployed, the digital asset that we've deployed at ICEA Lion Life, to make sure that then we can capture that population that is tech-savvy, that does not have the liberty of working or socializing us through our offices. They have a portal that is online, that is available for them to come in and make their contributions as we proceed.
George, tell us about the GCR ratings. I heard about it and I thought, and I was even asking, congratulations on it, first of all, and more importantly, is this an indication of some corporate action we should be expecting from ICEA Lion?
Julian, this company is premised on, one, good corporate governance, running of good fundamental financial models, but also choosing where to play. And in recognition of what has been done over the years, since the company started early in the 60s, this company has been well governed. All the fundamentals are right. All the financials, if you socialize our balance sheet, all financials are right. And because of that, we have been recognized as the only life insurance company in East and Central Africa that then gives out the best that we can have in terms of insurance companies. ICEA Lion Life has been given this rating because of the various models that we've learned, the adequacy in our capital. We run one of the highest capital to support our liabilities. Yeah. Our capital adequacy ratio is in excess of 300%. The threshold is 200%. And so we have a huge buffer to protect our clients, but also to come in handy when needed to support our clients. It is a testimony to the models that we run, the governance, and of course, the results that we produced over the years. Yeah. It is indeed a pleasure for us to be honored, but I think we take with the humility that this is for purpose of serving our clients. All this is meant to serve our clients better by giving them confidence that we will be there now, tomorrow, and to the future.
Okay. Looking back at the macro environment, and for many Kenyans right now, the biggest concern they have is the escalating inflation and the costs that come with it. And many are asking, even for us who are putting something aside for retirement, how do we ensure that our investment then keeps up with the escalating inflation? And I know you spoke about the power of compounding earlier on, but just flesh it a little more for us to get it.
It is basically to make sure that our clients out there, those who want to save in an insurance environment, to make sure that they select their providers wisely. We saw during COVID, some companies were disrupted. Some companies couldn't operate. Again, it's because of the preparedness that we've put in place over the years. Indeed, as we normally say, when the tide is low, that's when you know who's been swimming naked. And because of that, I think we've seen many companies struggle globally to support their models. But as the ICEA line, I think we were lucky. With hindsight, we put on the fundamentals in place, and we were able to navigate through the COVID. And even now, as we face an economic crisis, both global and regional, we are well placed to navigate through the same because of the fundamentals that we have put in place. We see ourselves as a company that looks beyond tomorrow. We may not be the ones that are at the top, but we see ourselves as sustainable, resilient, and listening to our customers. And of course, coming in handy when we are needed to provide the benefits for our clients. The economy hasn't performed well. We've seen rising inflation that potentially may erode the savings, but I think we have always adjusted the returns of our members, our policyholders, to make sure that we sustain their returns at the end of the day. If we don't do that, we lose our customers. But I'm happy to mention that over the years, we've kept our balance in terms of our policyholders, keeps on increasing because of the way we've served them. It also requires us to think again, as I said, outside the box, that beyond inflation, we have to think about alternative assets of investments that cushion members of our pool against any volatility in terms of inflation, etc.
I see. Speaking about alternative assets, many times I speak to trustees that will tell you that the reason why pension funds would be largely skewed towards fixed income is because typically we have low risk appetite. And the question then becomes, when you venture into alternative assets, how then do you ensure that much as you are taking on the diversity, you still calibrate your risk properly?
You have to run these two models, these two initiatives concurrently. You cannot potentially discard the traditional models of government bonds, treasury bills, equities, etc. But I think it's an idea of saying, in a case where some of these assets have not performed well, you are cushioned by thinking elsewhere. Investing in private equity, for example, if well done, well positioned, they provide a good return for any company, for any investor. Think about renewable energy, for example. This is uncharted waters. We have had interest now in many people investing in that, mostly risk-free. And investing in those assets that therefore guarantees, enables the investor to diversify their portfolio and hedge their risks. And as we know traditionally, there's the thinking that traditionally everything else has been risk-free. It's no longer the case.
Yeah.
We've seen instances where we have had issues elsewhere where government bonds have not performed, have not come to support members or the investors. So we are casting our net wide in terms of investments, making sure that even the ones that we have are re-engineered. For example, when you talk about property, investment in property, you re-engineer property portfolios to make sure they give us the best returns for our members. But also thinking, re-evaluating the equities, the stocks where we play, to make sure therefore that we exit when necessary, but stick in also when necessary to then be able to gain the best out of those investment assets.
One of the things which has really gained traction in the recent past is the conversation around ESG, environmental, social, and governance. And I'd like to get your thoughts around how you are positioning this enterprise as far as that is concerned, because of course, a lot of investment decisions now are pegged on compliance with that.
The ESG agenda has been pioneered by this company in terms of the insurance industry. And we want to play a pivotal role in that area because all the clients that we insure, both corporate and individual, have been affected by climate change.
Yeah.
Yesterday I was looking through the nation and I found a note on how the Baringo villages have been marooned by water, by floods, and their lives have been disrupted totally, forever. As a life insurance company, we have not played a very big role. Globally, life insurance has not played a big role in ESG, but our general compatriots, general insurance compatriots, have played a bigger role in identifying which assets need to be insured, which assets are convenient, which assets are complying with ESG so that they have some rebates to support them. But the entire agenda of ESG cannot be finalized unless all of us come together as an industry, and we want to bring together all our industry players to work together towards fulfilling that agenda. We see ourselves playing a bigger part in ESG in terms of reducing even premiums for those clients that are compliant, but also giving some incentives to those that have not started so that they can start and reap from the benefits of ESG. Global change, global climate will always affect the way we do business around here. And for life insurance, for now, what we see is the proliferation of diseases, which may affect mortality and morbidity. And for those, as a life insurance company, we are thinking, how do we then socialize our clients to make sure that the mortality assumptions that we put in our pricing don't go beyond what we priced.
I see. Spot on there. And one thing I'd like to get your thoughts, George, is this. How is the micro-insurance landscape? I remember when it began catching momentum in this market, it was billed as the way to get to the very bottom of the pyramid in terms of bringing guys into insurance, into pensions. When you look back and see where it is right now, do you feel content? Where do you think we can push the envelope a little further?
We have a lot to do in terms of bringing the micro sector into the fold of the insurance provision. Many companies, ourselves included, have ventured into micro by providing micro products and micro solutions to our micro population, so to say, the lower part of the pyramid. To be able to serve them better, there's a lot of education that is needed for the people below the pyramid to understand that the saving component of insurance is very different from other financial products, that they must save for the future. Ours is long term, but also we have to provide to them ideal products. We want to roll out soon a micro product to the lower part of the pyramid, but also using technology. We cannot succeed in reaching out the lower part of the pyramid, the micro sector, without having the appropriate technology. Our technology team is working around the corner to ensure that we have technology platforms that support us to distribute these products out there, to provide these products out there, the lower part of the pyramid. But also general education. We need to generally educate the populace about the advantages of saving, of having a life insurance product, so that eventually the knowledge then helps the micro sector to grow. Regulation is equally important, but I think we've seen in the recent past regulations being put in place, which was not there before. Yeah. That will help us then to anchor products well and serve our clients better.
All right. George, we're getting to the tail end of our conversation. As far as the competitive landscape is concerned, how do you assess your positioning? And the question which has now come up quite commonly is we've seen a number of players coming into the market, and some have even gone as far as arguing maybe the market is now concentrated in terms of players' perspective. What are your thoughts?
That question is better answered by our regulator, but let me put it this way. I think in this journey, we have big players and small players. We see that capital adequacy playing a bigger role in the regulation of insurance companies. The incoming of new companies is a welcome move. It widens up competition, providing better solutions to our clients, to the market, but again, making sure that all these companies are well capitalized to meet their liabilities. Now, at ICEA Life, we are the largest life insurance company in terms of asset base. We are the largest life insurance company in terms of capital adequacy. We are the pioneers in private pension schemes, and our private pension scheme, our DA, for example, pensions product is the largest in the market. Our DA product is 64 billion. Our personal insurance product, personal retirement benefit scheme, at around 30 billion. With good corporate governance, capital adequacy, okay, and the recognition of what we are doing, we think we are best placed to lead this market. We know also that in the market, there could be a few of our competitors who are struggling. Yeah. When you socialize the capital adequacy, for example, you look at the capital adequacy of some of these companies, it's wanting. Before COVID, the regulator had indicated that he was going to put in place to effect the capital adequacy regime, which you have not seen happening. And that has led to some of our competitors operating not in an optimal manner, to the extent that when it comes, for example, retirement benefit schemes, we invest in the same climate, same environment. We've seen some companies, fund managers, offering extremely high rates. They're not sustainable beyond the horizon. We want to run good models that are consistent with what we are operating in, but also resilient and sustainable going forward. And that is what ICEA Line is about: sustainability and resilience and support to all our policyholders at any one time.
All right. My final question, George, is what would be your parting shot, especially around the subject of pensions, to Kenyans at this particular time when many will tell you, look, our wallets are distressed. Our disposable income is really thinning out. What would be your parting shot?
To be able to answer that, you need to go outside of Kenya. Take, for example, a country like India, where the propensity to save is much higher, in spite of the income levels being low. It is the culture of saving that I think that will help us. Developing a culture of saving, that whatever little we have, if we save part of it, it will come in handy later in our lives. In spite of the pressures that the pay slips and our earnings have received from various initiatives to tax employees, etc., which is a good thing to build a country. But at the same time, as that pressure mounts, we need to ask ourselves, what do we save for our future? The future is waiting for us. and is only ready for those who will be able to set aside a little of the earnings to save for a rainy day. And that cannot be explained better than having various products that we do at ICEA at Lion Life. A personal pension scheme with a minimum of about 1,000 shillings, you can be able to save for retirement. If you wanted, for example, any other product, education product, it's available. Building our culture around savings will help us to cushion ourselves against the volatility of the economies in the future, our earnings in the future, and potential retirement when it comes, to enable us then have some lump sum to lean on when age catches up with us.
George Nyakundi, thank you so much for your time.
Thank you, Julian. My pleasure.
And that takes us to the close of our conversation with George Nyakundi, where we have been focusing on matters regarding pensions and the pensions landscape by and large, looking at a policy level, as well as emerging issues in the macro environment, including the distressed wallets, which is pushing us, many of us, not to save, and is saying a culture of saving is extremely critical if we are to change the fortunes of this country. Stay tuned for more on these insights.